It's the most shocking thing happening in the auto world right now. Dealerships slashing prices like never before, and yet crickets. Empty showrooms, bloated inventories, desperate sales managers pacing the floor, and record-breaking discounts that still can't move the metal. The American car market is in absolute chaos, and the writing on the wall is clear. This is no ordinary slump. This is a full-blown crisis. Walk onto a dealership lot today, and you'll see sticker prices slashed by thousands. $10,000 off a Ram 1500, $12,000 off a Jeep Grand Cherokee, 0% APR, no payment for 90 days, even cashback offers stacked on top. The deals look insane on paper, but buyers aren't biting. Foot traffic is down. Online leads are drying up. Salespeople who used to thrive on high commissions are now barely scraping by. And it's not just one brand. This is happening across the board. Ford, GM, Toyota, Hyundai, even luxury brands like BMW and Audi are starting to sweat. So what's going on here? Why are these massive discounts falling flat? The answer is deeper than just high prices. It's about trust, inflation fatigue, and years of pent-up consumer frustration. Buyers saw prices balloon during the pandemic. Dealerships marked up vehicles by $5,000, $10,000, sometimes even more. Now those same buyers are asking, why should we pay now, even at a discount, when we were gouged before? And let's not forget the 8% interest rates still floating around. Even with lower sticker prices, the financing is killing the deal for most middle-class families. Meanwhile, automakers are quietly panicking. Production hasn't stopped, which means inventories are stacking up. The average time a vehicle sits on a dealer lot is now over 80 days, a sharp jump from the healthy 30 to 45-day range. Some dealerships are stuck with 2023 models they still can't unload, and 2025 inventory is already on the way. That's turning showrooms into parking lots, and it's bleeding them dry. Floor plan financing costs are eating into profits. Some small-town dealerships are considering shutting down altogether. But here's where it gets even more alarming. Dealers are begging automakers to slow down production, and in many cases, the manufacturers are refusing. Why? Because Wall Street still expects growth. Stockholders want to see movement. So the automakers keep cranking out trucks, SUVs, EVs, everything, while demand is falling off a cliff. It's a ticking time bomb. Now, throw in the EV dilemma. Dealers are sitting on electric vehicles they can't move. Consumer interest has plateaued. Charging infrastructure is still lagging. And the high price of EVs, even after tax credits, just doesn't make sense for a buyer watching every dollar. Dealerships that invested heavily in EV training, infrastructure, and inventory are now regretting it. Some Ford dealers have started returning their EV certifications. The strategy has backfired, and the used market is not the escape route people hoped for. Prices are still elevated compared to pre-pandemic levels, and financing isn't much better there either. Repo rates are rising, defaults are ticking up, and lenders are tightening the leash. It's harder to get approved for a car loan today than it's been in over a decade. The consumer squeeze is real. So what's the endgame here? If dealers can't sell new cars, can't offload used cars, and can't rely on financing, how long can this model survive? Some are already calling this the Great Dealer Reckoning. Others are comparing it to the housing crash of 2008. Too much inventory, too few buyers, and a market correction that could ripple across the economy. In fact, some analysts are predicting a wave of dealership bankruptcies by the end of the year. Independent lots, especially in rural areas, are most at risk. These aren't just businesses, they're cornerstones of local communities. When they go under, the ripple effect hits hard. Mechanics lose jobs, local banks take hits on floor plan loans, and buyers have fewer choices, giving big city dealers even more control. And yet, despite the gloom, some dealers are holding out hope. They're banking on end-of-year sales, holiday incentives, and aggressive marketing campaigns. But the truth is, it's not working. Customers are smarter now. They've been burned by markups, delays, and poor service. They're not just looking for a deal, they're looking for fairness. And unless the industry changes fast, that trust may never come back. The cracks in the foundation are spreading. Even service departments, once the reliable cash cows for dealerships, are starting to feel the slowdown. Fewer new car sales mean fewer warranty repairs. And with people holding onto their vehicles longer, they're stretching out oil changes, deferring maintenance, and avoiding the dealership service bays altogether. Technicians are standing around with fewer repair orders to complete. The service lanes, usually buzzing with activity, are going eerily quiet in many locations. Meanwhile, pressure from corporate is intensifying. Automakers are still pushing lofty sales quotas, demanding flashy showrooms, expensive renovations, and digital upgrades, all of which cost millions. Dealers are being forced to invest in these changes just to stay part of the network, even as profits dwindle. It's a lose-lose situation. Comply and go broke trying to modernize. Refuse and risk losing the franchise entirely. That's not partnership. That's survival under pressure. Then there's the customer mindset, which has fundamentally changed. Shoppers have shifted online. They're doing hours of research before even stepping onto a lot, if they step on one at all. They know the invoice prices. They know what the dealer paid. They've read the horror stories of dealer markups, hidden fees, and last-minute financing tricks. So when they do walk in, they walk in ready, not to browse, but to negotiate hard or walk out fast. That dynamic has flipped the script. The old will wear them down strategy doesn't work anymore. And let's not forget the looming threat of direct-to-consumer sales. Brands like Tesla and Rivian have already broken the traditional dealership model. Buyers configure online, pay online, and have the car delivered to their door. No haggling, no games. And consumers love it. So why haven't legacy automakers made the shift? Because franchise laws still give dealers a powerful grip on the system. But for how much longer? States are already debating reforms. And with consumer sentiment turning sharply against traditional dealers, the writing is on the wall. You add all of this up, the bloated inventories, the disillusioned buyers, the broken trust, the financing nightmare, the EV stagnation, the online disruption, and you start to realize this isn't just a rough patch. This is a complete unraveling of the dealership model as we know it. It's not just about lowering prices anymore. It's about changing the entire way Americans buy and sell cars. And the clock is ticking. Still, the industry keeps pushing like it's business as usual. Flashy incentives, bigger ads, deeper cuts. But every week that passes without real buyers walking in is another nail in the coffin. The truth is, prices could fall another $5,000 across the board, and it still might not be enough. Because the problem isn't just cost, it's confidence. People don't trust the system anymore. And without that trust, the discounts are just numbers on paper. And while the big three automakers scramble to pivot, international players are starting to sense opportunity. Chinese brands like BYD are preparing to enter the US with aggressive pricing, simpler buying processes, and EVs that cost half of what a Ford or GM model does. If dealerships are struggling now, just wait until that tidal wave hits. Consumers are hungry for change, and foreign automakers are positioning themselves to deliver it. Meanwhile, behind closed doors, dealer associations are pleading with lawmakers for help, bailouts, tax incentives, anything to keep the lights on. But sympathy is in short supply. Politicians know public sentiment is turning. Supporting dealerships right now would be politically risky. Most voters don't see them as local businesses. They see them as middlemen who overcharge them during COVID. And memories of $10,000 markups don't fade easily. So what happens next? Will dealerships finally evolve? Or will they collapse under the weight of their own resistance to change? The next few months will be critical. Holiday sale season is coming. Interest rates could shift. But unless something drastic happens, this may not just be a slow decline, it may be a total collapse in slow motion. Some insiders are calling it the extinction event for the traditional dealership model. And the scary part? Most of them saw it coming, but were too slow, too entrenched, or too confident in the old ways to adapt. Now the ground is shifting beneath their feet, and the survival rate is plummeting. The data is brutal. As of this quarter, dealership profit margins have dipped to their lowest point since 2012. Many lots are operating at break-even or worse. Dealer closures are quietly accelerating. Over 400 dealerships in the U.S. have either shut down or consolidated in the past 18 months. These aren't just underperforming locations. We're talking about long-standing, family-run operations, some around for 50 years or more, that simply can't compete with the pressure of modern-day auto retail. At the same time, consumer behavior is rewriting the rules. Subscription services, flexible leases, and car-sharing platforms are eating into traditional ownership models. Younger buyers, especially Gen Z, aren't dreaming of owning a car the way older generations did. They're pragmatic, debt-averse, and tech-driven. They want convenience, transparency, and simplicity. A dealership lot full of 7-year loans, hidden fees, and upsell pitches doesn't align with their expectations. That's a massive generational shift, and the industry is not ready for it. Meanwhile, the digital revolution is kicking into high gear. Online marketplaces like Carvana, Vroom, and Cars.com are growing their market share, even after recent stumbles. They're offering what dealerships still struggle with: instant financing, home delivery, 7-day return policies, and no haggle pricing. Sure, they've had their bumps, but they're evolving fast. And every car they sell online is one less customer walking into a traditional dealership. On the back end, banks and lenders are becoming more cautious. Credit tightening means fewer approvals, stricter requirements, and more deals falling apart at the last minute. That puts even more pressure on dealers, who already lose hours negotiating and finalizing sales that end up collapsing due to financing issues. It's not just frustrating, it's draining. Time is money, and dealers are bleeding both. And all this while car prices, even after recent drops, are still historically high. The average new car transaction price is hovering around $47,000, completely out of reach for the average American household. Even with discounts, it's still a major financial stretch. Monthly payments above $800 are becoming the norm, not the exception. For many, that's just not sustainable. Dealers are trying to fight back. You'll see aggressive promotions, blowout events, liquidation sales, employee pricing for everyone. Some are even experimenting with home test drives, mobile service vans, and no-pressure sales guarantees. But it feels like patchwork, because the core issue remains: buyers have changed, and the old system hasn't. And yet, in the middle of all this chaos, one question keeps coming up. Can the dealership model be saved? Can it be reinvented to meet the demands of a post-pandemic, digitally savvy, economically strained consumer base? Or is it too late? What's clear is this: doing nothing is no longer an option. The current path leads to more closures, more layoffs, and more headlines about the death of the dealership. Something bold has to happen. Whether it's a full embrace of digital retail, a shift to a hybrid sales model, or a complete teardown and rebuild from the ground up, transformation is no longer a buzzword. It's a necessity. And if they don't move fast, well, the next time you pass by that dealership in your town, it might not be open at all. And as this slow-moving storm builds, there's one more layer dealers can't ignore: customer revenge. That might sound dramatic, but it's very real. Many consumers remember how they were treated during the shortage years. Markup madness, stripped-down trims sold at premium prices, cash buyers being turned away for lack of financing profit, and even longtime loyal customers being shoved aside for whoever could pay the most. Today's silence in the showroom is part sticker shock, part interest rate pressure, but it's also payback. Consumers aren't just hesitating. They're choosing not to come back. It's not just buyers walking away. Sales staff are leaving too. The once coveted role of a dealership sales consultant is losing its appeal fast. Commission structures are drying up. Job security is unstable. And many of the top performers are being lured away by tech startups, direct-to-consumer EV makers, or other industries entirely. The talent drain is real. And when skilled, trustworthy salespeople walk away, customer satisfaction suffers even more. It becomes a vicious cycle: bad experience, bad reputation, lower traffic, more financial stress. In the midst of this chaos, some forward-thinking dealers are making bold moves. They're cutting overhead by going fully digital. They're ditching giant lots in favor of central hubs with virtual showrooms. They're focusing more on after-sales relationships, service subscriptions, maintenance plans, lifetime perks, anything that builds long-term trust. A few are even joining forces with fintech companies to offer in-house financing alternatives that bypass the traditional lending system entirely. But let's be clear, these are the exception, not the rule. The vast majority of dealers are still clinging to the traditional model, hoping for some kind of miracle recovery. Maybe lower interest rates, maybe a surge in demand, maybe a government program to boost car buying like Cash for Clunkers did in 2009. But hoping is not a strategy. And while they wait, the market keeps evolving around them. And all of this is happening while a new generation of car makers is entering the scene. VinFast, BYD, Zeekr, Neo, all of them building cars with modern styling, tech-first features, and no dealership middleman. They're coming in lean, agile, and ready to break every rule in the US auto playbook. Legacy brands, still tied to bloated dealership networks and outdated processes, are struggling to keep up. What we're witnessing isn't just a dip in sales or a cyclical correction. It's a full-on industrial shift. The dealership model, once a cornerstone of the American economy, is now a crumbling structure trying to withstand a digital tsunami. The consumer has changed. The product has changed. The expectations have changed. And unless the gatekeepers of this industry evolve just as quickly, their extinction is not just likely, it's inevitable. And here's the final twist. Many consumers aren't mourning the downfall. In fact, some are cheering it on. Because to them, fewer dealerships doesn't mean fewer cars. It means fewer games, fewer surprises, and finally, maybe an honest, direct, and modern car buying experience. One without the middleman. That public attitude, that sense of good riddance toward dealerships, is perhaps the most dangerous threat of all. Because it means that even if dealers fix prices, revamp service, and roll out better tools, they're still fighting against a wave of resentment that's been building for years. For many customers, the dealership isn't just a place to buy a car. It's a symbol of outdated power structures, hidden fees, and pressure tactics. That perception doesn't fade with one big sale or a slick new website. It takes years of rebuilding trust. And right now, time is something dealerships don't have. Let's talk numbers again, because the financial cliff they're standing on is steep. Floor plan interest costs, basically the interest dealers pay just to keep cars sitting on the lot, have doubled in the past 2 years. Some dealers are paying over $1,000 a month just to hold a single vehicle. Multiply that by hundreds of unsold cars, and you're staring at a financial furnace burning through their bottom line. Many are now selling cars at a loss just to stop the bleeding. And once you start doing that, you're not managing a business. You're bailing water on a sinking ship. And with pressure coming from every direction, consumers, automakers, banks, tech rivals, and foreign brands, the cracks are widening faster than most realize. You have automakers pushing more direct sales strategies behind the scenes, especially with EVs. Tesla and Rivian proved it can work. Ford and GM are watching. And the more these legacy brands get burned by slow-moving dealers sitting on unsold stock, the more likely they're to ditch the old system entirely. Meanwhile, tech platforms like Amazon are inching closer to full vehicle retail integration. Imagine being able to buy a new car online with the same ease as ordering a microwave. It's not science fiction, it's coming. And when it does, the middlemen get pushed out unless they evolve into something radically more useful. But here's the wild card. What happens when automakers start pulling the plug on underperforming dealerships? That's a conversation already happening behind closed doors. Quiet terminations, reduced allocations, license renewals not being offered. It's not loud. It's not public, but it's real. Some manufacturers are starting to trim the fat because they can't afford to have slow dealers dragging down brand image and quarterly numbers. And it gets even trickier when you look at rural communities. In small towns across America, the local dealership isn't just a place to buy a car. It's a sponsor for the Little League team, a job creator, a central part of the local economy. If those dealers disappear, entire communities will feel the impact. But automakers, driven by Wall Street expectations and global competitiveness, may not see those communities as sustainable anymore. Cold, but real. Then comes the policy question. Will the government step in to protect these franchises? Will we see dealership bailouts like we saw for banks and automakers in 2008? Or will policymakers let the free market take its course? The answer likely depends on how big this collapse gets and how loud the fallout becomes. Right now, it's a quiet crisis, but it won't stay that way for long. Let's take it to the final chapter, the part that automakers are trying to avoid talking about, their own exposure to this collapse. Because here's the uncomfortable truth. If dealerships fall, automakers don't walk away clean. They lose their distribution network, their customer interface, and a huge portion of their servicing infrastructure overnight. A widespread dealer implosion wouldn't just be a local problem. It would ripple all the way to Detroit, Germany, Japan, and Korea. Manufacturers would be forced to scramble for alternatives, either building out direct-to-consumer systems from scratch or relying on third-party platforms they don't fully control. That means delays, reputation hits, and billions in restructuring costs. And it's already happening in small doses. Ford's Model E program, which pushed dealers to invest up to $1 million in EV infrastructure, has seen hundreds of dealers opt out entirely. GM is offering buyouts to Buick and Cadillac dealers who don't want to transition to EV sales. These aren't outliers, they're stress signals. Signals that the old relationship between automaker and dealer is breaking down. But here's where the real pivot comes. Some dealerships are waking up. They're not just reacting, they're rebuilding. They're ditching outdated sales tactics. They're investing in seamless digital platforms. They're offering transparent pricing, home delivery, and lifetime service guarantees. They're turning their service departments into high-tech repair hubs for both ICE and EV vehicles. They're retraining staff not to close deals, but to build relationships. These are the dealerships that will survive because they're listening to the market, listening to customers, and most importantly, listening to the signals that change isn't coming. It's already here. The rest? The ones still playing the old games, still hiding fees, still waiting for things to go back to normal, they won't make it. This isn't just a rough patch. It's a realignment of the entire auto retail landscape. So what's the takeaway for the everyday buyer watching this unfold? Be patient. Be smart. Don't rush into a bad deal. The leverage is shifting in your favor. And as the market continues to adjust, the power is going back to where it should have always been, with you. Because when dealerships fall, and they will fall, it won't be because people stopped buying cars. It'll be because people stopped buying. This is the dealership reckoning, and it's only just begun. Thanks for watching. Make sure to like, subscribe, and drop your thoughts below. What's your take on the future of car dealerships?